If you're about to invest, stop right there, because I do not want you to make the same mistake that I have made for so many years. And I'm just trying to save you from your money. It's like lending your money without knowing when you're going to get back with interest. And this is exactly what stocks and shares are. It's basically banking on future gains, and future gains are not always certain. So in this YouTube video, I'm going to give you the top 10 crucial things that you need to know before investing. Trust me, if you do not do this, if you do not take these steps, you could end up losing all your hard-earned money. So the first of these lists is to do with goals. Investing can be very exciting, but without clear goals, you might end up heading for failure. Ask yourself this question: are you looking for long-term growth or short-term returns? Once you know exactly what your objectives are, you can select investments that align to those goals. For example, my wife and I want to retire at 55 and rely on dividends from our stock market earnings. Having clear goals help you to make smarter investment decisions and stay on track towards achieving your financial aspirations. The next part is to do with risk tolerance. Before investing your hard-earned money, it's important to know that all investments have some level of risk. Don't let anyone fool you on this. Consider how much your risk tolerance is, how comfortable you are before making your investment decision. Ask yourself this question: can you handle the market fluctuations, or if you rather prefer safer options like bonds or mutual funds? It's also essential to find the right balance between taking too much risk and stressing out, and playing it too safe and missing out on growth opportunities. Once you've identified your risk tolerance and investing goals or investment goals, create a clear plan that basically works for you to reach those goals. You can diversify your portfolio by investing in a mix of stocks, bonds, index funds, or real estate investment trusts. Stick with the strategy that you choose, even if the market starts to fluctuate in the short run. Investing is like a long-term commitment, not some one-night stand. There's no quickie here. Market timing. Okay, before investing your money, it is important to look at the bigger picture. Just get up and look at the bigger picture. Is the market doing well or not? Are interest rates high or low? Consider the economic trends and world events that could actually affect your investments. Missing out on some of the best days in the market can actually hurt your earnings. So think about it. For instance, a study by JP Morgan Asset Management found that if you invested $10,000 in the S&P 500 on January the 3rd, 2000 and kept it there until December the 31st, 2019, you would have made on average 6% per year, turning your $10,000 to $32,421. But if you missed the 10 or 20 best days during the time, you could have earned a lot less or even no money. So it's crucial to stay informed and be patient for a successful long-term investment. Let's talk about something that could ruin your investment profits. Okay, most investments come with charges like management fees, commissions, expense ratios, or ongoing cost fees. These can accumulate over time and reduce your returns. So it is crucial to monitor these expenses and compare the fees of various investment options that are available. But there are good news. By selecting low-cost investments, you could actually keep more of your earnings. Stay tuned for future episodes where I basically show you how you do it. The next part is to do with taxes. Taxes can be a real pain. It can also be as dry as watching a paint dry, but it's important to understand how they affect your investments. Capital gains tax is the tax on the profit that you make when you sell an asset for a higher price than you paid for it. The government basically takes a cut, and it depends on your gains and the tax bracket that you're in. To keep more of your money, consider investing in the tax-exempt accounts like self-invested personal pensions or ISAs. When buying shares electronically as well, you may have to pay something called the stamp duty reserve tax, which is 0.5% of the transaction. Investing in mutual funds when there are no good deals can really help you avoid that. This is very important. Education. It's as important as location. If you are in the property business, you know exactly what I'm talking about. Now, Take some time to educate yourself by reading books, listening to finance podcasts, and even watching YouTube videos like mine to basically broaden your horizons and expand your knowledge. Also boosting your confidence as well, because you know exactly what you're doing when you are educated. And be sure to support me, by the way, by liking, subscribing, hitting that bell notification so that you are up to date. I just wanted to squeeze that in there. The next part is to do with market psychology. Investing can be a wild ride. I mean, a seriously wild ride. Sometimes the numbers go up and it feels amazing. You feel like you're on top of the world and you feel like you can do anything. The weather song is playing. It's a lovely day. It's nice and bright. But here's the thing. There are other times when the market goes down and it can feel so scary. You might be panicking, thinking that there's something wrong, everything's not going right. It's important to keep your emotions in check, at bay when you're investing. If you invest based on fear or greed, you will likely end up losing all your money and be in trouble. Instead, take some time, take a deep breath, actually move away from all the things that you're doing in the market and try to think rationally. Think about your investments. Don't let your emotions drive your investment decisions. The next part to do with strategy. A great investment strategy from some of the world's best investors like Warren Buffett and Charlie Munger is to be greedy when others are fearful and to be fearful when others are greedy. It's like, how do I compare it? It's like getting great deals on Black Friday. When the market is in a panic, be sure to stay liquid, have enough cash available so that you can buy amazing stocks at discounted deals. Always keep in mind that investing is for the long run, the long game, and it's not a quick win. So it's important to stay calm, disciplined in your investment approaches. Think about your investment portfolio as a healthy meal. Just like you need a variety of foods to stay healthy, you also need a variety of investments to minimize your risk and also increase your return, maximize that return. Diversifying your portfolio across different sectors, regions is important to spread those risks and also capitalize on growth opportunities. Don't put all your eggs in one basket. Even if you're going to do that, make sure you diversify based on the amount of money that you put in as well. I'm going to teach you that in future. Personally, I prefer equities as they have a proven track record of making over 6% for the past 200 years, followed by fixed income securities, 4%. And you know what? Gold or commodities hasn't really made much. In fact, they've actually made less, minus. They haven't even beaten inflation. I'm going to end it here by saying thank you for listening to me. I hope you take these information, these messages that I've shared with you. My voice right now is flipping croaky because I can't even talk properly. I'm still not feeling well. But hey, you know what? You've got to stay invested. Let the money still run.